Don't let the quiet fool you. When the market goes silent, most people relax, because the chart looks harmless and the last price feels settled. But silence isn't safety, it's setup. Right now the screens look dead. Volume is thin, everyone's mentally checked out for the holiday stretch. And that's exactly why the pressure can build without anyone noticing. In the background, the real decisions are getting made: risk limits, rebalancing orders, portfolio mandates, systems that don't care about vibes, only rules. Here's the clock you need to watch tonight. When futures flip back on, liquidity comes back like a light switch. And when that switch flips, money that's been parked for weeks doesn't tiptoe in, it rushes. Not because people suddenly feel bullish, but because institutions are forced to move at the start of a new year. And this year there's a problem. The models point to the same place at the same time. Silver. But the real market isn't just a number. Check the physical side: premiums, ship dates, sold out signs. If supply is tight and forced money shows up together, price doesn't drift, it snaps. The countdown is already running. The only question is whether you're watching the headline or the mechanism. The quiet is not comfort. It's the warning light: dim, steady, easy to ignore until it's too late. The market looks closed. The screen looks empty. And silver sits there like a statue around $71.47. As if nothing in the world could possibly change while everyone's eating leftovers and posting holiday photos. That's exactly the illusion. When the chart goes quiet, most people stop paying attention. They assume risk goes to sleep with the volume. They assume the last print is a fact, something solid you can lean on. But the real market isn't the number on your screen. The real market is what happens when nobody's watching. Inside the risk rooms. Inside the committee calls. Inside the mandates and exposure limits that control institutional money like guardrails on a cliff road. That's where the next move gets built. Not with fireworks. With checklists. With rebalancing instructions. With margin rules that tighten without announcing themselves. With reduce here, rebuild there, don't exceed this, be flat by year end, be ready after the calendar flips. You don't see any of that on the chart. You only see the silence it leaves behind. And holiday silence is the perfect cover. Families are unplugged. Traders are half-staffed. Liquidity thins out like air at altitude. Spreads widen. Dealers get conservative. Inventories don't magically refill just because the calendar says December. So the screen can look calm while the plumbing underneath is getting stressed. That's what makes silver so dangerous and so revealing. When the plumbing is healthy, silver drifts. It behaves. It prints neat decimals that feel like physics. When the plumbing chokes, silver doesn't drift. It teleports. It jumps through levels as if the market skipped frames. People call it volatility. The script calls it what it is: a system under pressure showing you its seams. Now put a clock on it. Futures reopen electronically on Globex at 6 p.m. That's the moment the illusion gets tested. Because the instant liquidity returns, the market has to reprice reality. And reality doesn't care that you were offline. What looks like a quiet chart at 4 p.m. can become a gap at 6:01. And that gap isn't news. It's consequence. It's the visible result of positioning that happened off camera, capital commitments that were made while you were assuming nothing could happen. That's why waiting for headlines is a losing strategy. Headlines arrive after the fact. They explain the move you already missed. They give you a story to soothe your brain while your entry gets worse and your risk gets bigger. This is the opening promise, not a mystical prediction, not a hype pitch, but an autopsy and a playbook. The narrator isn't saying, silver will do X. He's saying, here's why the quiet matters. Here is how the structure sets the trap. And here is why the first week of January is when hidden forces become visible. If you understand that, you stop treating silence like safety. You start treating it like staging. You look at the closed market and ask the correct question. Not, why is nothing happening? But, what is being prepared right now that will look inevitable later? Because in this game, the move doesn't start when you see it. It starts when you stop watching. That's why the quiet matters, because the quiet is not empty time. It's setup time. And the moment the calendar flips, the setup collides with something even more powerful than sentiment: forced flow. January isn't special because people feel bullish. January is special because institutions had to move. Not because they woke up inspired, but because their machinery restarts. The committees come back online. The mandates reopen. The models update. The allocation bands that were paused for reporting suddenly become active constraints again. And when constraints turn back on, money doesn't ask permission, it executes. Most retail traders think in stories, headlines, narratives, vibes. Institutions think in instructions. A pension fund isn't excited about silver. An endowment isn't scared of inflation because of a tweet. They operate inside policy documents and rebalancing thresholds. If a portfolio drifts outside its target band, it must rebalance. If risk metrics trip, exposure must be reduced or shifted. If a new year begins, targets reset and capital gets deployed according to a plan that was approved months ago. That's why the first week of January can feel like a different market. It's not a mood swing. It's a mechanical event, like turning on a factory line after a shutdown. Now combine that with what you already know from the quiet. Liquidity is still thin. Spreads are still wider than normal. And dealers are still cautious after the holiday lull. That's the collision. Size meets fragility. Huge pools of capital start moving at the same time the market structure is least capable of absorbing it smoothly. So instead of neat, polite two-decimal price discovery, you get abrupt repricing. The chart doesn't trend. It jumps. It gaps. It runs stops. It prints candles that look wrong. Because the order book is not deep enough to digest institutional flow without slipping. And here's the part that makes it self-reinforcing. The first push creates pressure everywhere else. Fund managers aren't just managing money, they're managing career risk. If silver starts moving and you're not in it, you don't just miss profit. You risk underperforming peers. You risk explaining to a committee why you didn't see it. So once the first wave hits, the second wave often follows, not because the thesis changed, but because performance math changed. Missed the initial move? Now you're late. Late is painful. Pain creates urgency. Urgency creates buying. And buying becomes its own proof. That's how institutional FOMO works. It's not emotional hype. It's professional survival disguised as discipline. This is why the script treats January volatility as a scheduled stress test. The market is tight. The flows are heavy. The calendar is the trigger. What looks like a sudden breakout to the casual viewer is often the visible result of mandates being executed in a market that can't absorb them quietly. The move feels random only if you ignore the calendar. If you respect the calendar, it becomes predictable in shape: thin liquidity, early impulse, fast repricing, and then the scramble to interpret it after the fact. So you don't watch January the way you watch April. You watch it like you'd watch a bridge when the first convoy rolls over it. You look for tells. One of the cleanest is Friday morning volume. If the flow is real and institutional, volume shows up early and stays heavy. If volume is weak, you treat the move as suspect. Maybe the market is still setting the trap. Maybe there's one last shakeout before the real wave arrives. Either way, the message stays the same. January isn't vibes. It's a machine turning back on. And when that machine turns on in a tight market, silver doesn't whisper. It speaks in gaps. If January is the machine turning back on, then the next question is simple. How much weight is that machine about to put on a market that isn't built to carry it? Because forced flow only becomes explosive when it meets a container that's too small. And this is where the script widens the aperture and drops the headline math. The kind of math that turns maybe, into a structural problem. The narrator calls it a $50 billion wall of capital. And the point isn't to impress you with a big number. The point is to show you how a tiny decision inside a gigantic system can behave like a flood when it hits a narrow pipe. Start with the scale of institutional money. Global pensions, endowments, and long-duration pools collectively sit on something like $50 trillion. That number is almost too big to feel real. So the script doesn't ask you to imagine all of it moving. It asks you to imagine 0.1%. Not a revolution, not a mania, a rounding error, a committee deciding, increase real assets slightly, a risk model nudging allocations because inflation is sticky and bond volatility is rising. A policy band that says, add a small hedge, that's it, and 0.1% of $50 trillion is $50 billion. Now drop that $50 billion into silver and ask what happens. Not emotionally, mechanically, Silver is not a deep sovereign bond market where a $50 billion shift gets absorbed like a wave in an ocean. Silver is a channel, a narrow one. The script makes this intuitive by comparing demand to supply. Annual mine output, valued at current prices, is on the same order of magnitude as that $50 billion impulse. In plain English, a small portfolio tweak can equal something like a year's worth of production in dollar terms. And when demand shows up in a market where supply can't instantly expand, the market has only one tool left to balance it: price. That's the brick wall of scarcity. The wall isn't a chart line. It isn't resistance drawn by a YouTuber. It's physics disguised as finance. Too much flow hitting too little available metal at the old price. So the market doesn't politely revalue by 50 cents. It has to ration. It has to push the price higher until enough sellers appear, or until the buyers are priced out. That's why the script insists the real danger is not mass belief, but marginal allocation. You don't need every institution to become a silver evangelist. You just need a fraction of them to obey a mandate at the same time. And this is the part retail consistently misses. Retail thinks in terms of buying moves the price. Institutions can become the price. When the flow is that large relative to the container, it stops being price-taking behavior and becomes price-setting behavior. The market doesn't ask, "Is this reasonable?" It asks, "How high do we have to go to clear the imbalance?" That's the logic the script is building toward. January is the ignition. Forced flow is the engine. And this math explains why the first real wave doesn't arrive as a trend. It arrives as a repricing event. If the $50 billion wall explains why silver can reprice, the next question is how that repricing actually shows up on your screen. Because markets don't move in theory. They move through structure. They move through sessions. They move through the thin seams in the day when liquidity is weakest and the fewest eyes are watching. That's why, after scale, the script pivots to timing and delivers the part most people underestimate. The move can start while the US sleeps. Here's the setup. Futures reopen electronically on Globex. And from that moment the market is live even if America is mentally offline. Asia and Europe don't wait for New York to confirm anything. They trade their session, with their inventory, their risk limits, and their own urgency. And that creates a specific kind of danger: gap risk. In thick liquidity, buying pressure shows up as a smooth grind. In thin liquidity, it shows up as a jump, price skipping levels because there simply aren't enough resting orders to absorb the flow at the old quote. That's how you get the kind of candle that makes people swear it's manipulation. Not because a villain pressed a button, but because the order book was shallow and the flow was real. Shanghai becomes the early heartbeat in this story. Not as mysticism, no Asian whales, no folklore, but as plumbing. Different sessions reflect different availability and different demand. If early buying appears in Shanghai or during Asian hours, the spread between venues opens up. And spreads don't stay open for long, because algorithms are built to hunt them. Arbitrage desks see the mismatch. Lift offers where it's cheap, sell where it's rich, and in doing so they pull Western futures into alignment. The gap becomes the headline. But the cause is boring and brutal: thin session impulse plus systematic arbitrage. Software linking markets faster than humans can blink. Now add the asymmetry that turns structure into psychology. Retail is asleep, literally. Unpositioned, unhedged, waiting for morning coffee and a clean chart. Meanwhile, desks that watch 24-hour markets are already responding. Already building positions. Already paying the lowest, real, price they'll see that week. Then the US wakes up to a new regime. Silver is no longer where it was. It's somewhere else. And that is a psychological ambush. People see the gap and their brain tells them the same lie every time: I missed it. They chase. They market buy. They add fuel to the very move they fear. Because the pain of being left behind overrides the discipline of waiting for structure. This is why the script treats early session behavior like a diagnostic tool. Not trivia. The first Globex print becomes a tell. A clean gap up signals urgency, real demand hitting thin liquidity, forcing price discovery forward. A dip, especially a sharp one, is framed as the last shakeout, a final move designed to punish late hands. Trigger stops, and reset positioning before the larger breakout resumes. Either way, the message stays consistent with everything before it. The system doesn't reprice when the crowd is ready. It reprices when the structure allows it, often in the dark. Often in the thin hours. While the loudest audience isn't even in the room. And once you understand that the move can begin in the thin hours, while the US sleeps, the next layer becomes unavoidable. Who benefits from that timing? And why would they want the tape to look a certain way right when nobody's watching? This is where the script drops the title claim, "They flipped long," but it does it carefully. Not as a cartoon conspiracy. Not as one villain pulling a lever. As incentive engineering. As optics. As a system that rewards certain behavior at certain dates. And punishes it at others. Year-end is not just a page turn on a calendar. For banks, it's a photo shoot. Regulators and internal committees capture snapshots, balance sheets, risk-weighted exposure, VAR, leverage, inventory, metrics that shape capital requirements, risk ratings, and, yes, bonuses. When the picture is being taken, the optimal behavior is to look smaller, cleaner, safer. That doesn't mean banks stop trading. It means they manage the appearance of risk. They shrink exposure. They reduce inventory. They cut leverage. They avoid being caught holding big positions that make their books look aggressive when the scoreboard freezes. And here's the part retail doesn't see, sometimes. The easiest way to reduce exposure is to lean on price in crowded trades during illiquid windows. If liquidity is thin and you push the tape lower, you can trigger stops, force weaker hands out, and buy back risk at better levels, while your year-end book still looks disciplined. The market calls it volatility. The script calls it timing. The point is not that every move is engineered. The point is that the incentives are real. And when incentives are real, behavior becomes patterned. Then the snapshot passes. The auditors leave. The regulators take the picture and walk out of the room. And instantly the reward function flips. Now the bank is no longer penalized for carrying risk into a reporting date. Now it can rebuild. Now it can expand. Now it can position for the wave that the calendar practically guarantees. January rebalancing. Institutional allocation. Forced flow. In that framing, flipping long isn't a betrayal of principle. It's the rational move once the optics no longer punish risk. That's why the script uses JP Morgan as the emblem. Not because it needs a villain, but because it needs a symbol the audience recognizes, a stand-in for the dealer class that sits closest to flows. The alleged leak isn't a document dump. It's a narrative of how desks front-run reality. They see client interest. They see rebalancing pressure. They see the demand before it hits the screen. So they position first, quietly, then sell into the rally when the public finally arrives with headlines and emotion. And that's the structural gut punch. Banks can potentially get paid twice. First by benefiting from a year-end squeeze lower in thin liquidity. Then by owning the rebound when forced buyers arrive and liquidity returns. In this story, the switch isn't proof of a secret meeting. It's proof of a calendar, a scoreboard, and incentives that make the same play repeat. Which sets up the next chapter perfectly. The public doesn't buy the move early. The public buys the explanation late, right after the price already moved. And once you accept that incentives can bend the paper tape, once you understand how year-end optics can make price look clean, when it's anything but, the next question becomes unavoidable. Where do you go to verify reality? Because if the screen can be leaned on, if the futures quote can be massaged by thin liquidity and balance sheet timing, then you need a lie detector. In the script, that lie detector isn't a headline. It isn't a tweet. It isn't even the spot price. It's the physical market, the messy, inconvenient place where you either get metal or you don't. This is where the narrator shifts from theory to friction. He describes a dealer blackout, inventory vanishing, back orders growing, delivery windows stretching out like rubber bands. The website might still show a price, but the product page tells the truth. Out of stock, ship date unknown, pre-order, or the more honest version, a price so absurdly high it's basically a go away sign. Because they can't take your order if they can't replace the metal. That's why premiums matter. Premiums are not a rounding error. Premiums are not noise. Premiums are the gap between a paper reference point and a real-world scarcity. If spot says one thing and premiums say another, the premiums are the market voting with its feet. The script leans hard on this distinction. Spot is a number you can print. Physical is a constraint you can't negotiate with. When dealers are charging $20 over spot and still selling out, the implication isn't that buyers are irrational. The implication is that the two-decimal quote is no longer doing the job of price discovery. It's lagging behind reality. It's describing a market that exists on screens, not in boxes. And when you see that lag, you're not watching a normal bull market. You're watching a system start to decouple. Then the narrator connects retail tightness to the part that really matters, industry. Because you can tell yourself a coin shortage is a hobbyist problem. You can dismiss retail as stackers being dramatic. But manufacturers don't live on vibes. If you need silver for electronics, solar, medical components, if your supply contract is on the line, you cannot wait for a dip the way a speculator can. You secure supply. You pay up for certainty. That's why the script mentions private deals far above spot. Numbers floating around $80 an ounce. Not as a promise of where the chart will go tomorrow, but as evidence of what real buyers will do when delivery is the bottleneck. At that moment, the market stops being about price and becomes about availability. And then it turns geopolitical. Because scarcity doesn't exist in a vacuum. The script references China tightening control over critical mineral exports as another accelerant, not a single trigger, but a reason for Western buyers to panic quietly. If you think restrictions could tighten, you don't wait. You bring orders forward. You stockpile. You compete for inventory now. While the paper quote still looks reasonable. That's how shortages become self-fulfilling. Fear of future constraint becomes present demand. The visuals in this section are cinematic for a reason. Vault ounces being counted, pallets moving, metal flying to Shanghai. It's not decoration, it's framing. The narrator wants you to feel the difference between a number that can be printed infinitely and an object that has to be mined, refined, shipped, and delivered. Paper pricing can look orderly while the real market quietly empties. And in the script's logic, that mismatch is the fuse. The break shows up first in sold out signs and widening premiums. The repricing shows up later on the chart, sudden, violent, and framed as a surprise. But it isn't a surprise if you've been watching the lie detector the whole time. And once the physical market starts acting like a lie detector, once premiums detach, inventory disappears, and delivery becomes the real price, you're forced to confront the bigger question the script is quietly steering toward. What if this isn't just a silver problem at all? What if the shortage is simply the first crack you can see? And the real pressure is monetary, trust, credibility, and the value of the unit you're measuring everything in. That's where the macro chapter flips the story from metal into money. In this framing, silver isn't only reacting to ounces. It's reacting to a surplus of paper claims, a surplus of currency, and a system that keeps promising stability while quietly becoming more fragile. The script paints the world as drowning in US debt. Numbers like $36 trillion are used as a symbol of scale, and it argues the bond market starts pushing back. Not with speeches, with yields, with refusal, with the cold logic of math. Then it drops a calendar pin, February 2026. The debt ceiling fight returns. And the narrator treats it less like political theater and more like a recurring stress test for the risk-free asset. In the script's logic, this round is different because the carrying cost has exploded. Claims of over $1 trillion a year in interest are presented as the new reality, so the margin for error is gone. When the bill for past promises gets that large, every policy choice becomes ugly. From there, the story tightens into a confidence spiral. If the fight escalates, the narrator suggests rating agencies hover again, downgrade threats return, and foreign buyers hesitate, because holding treasuries is no longer just a yield decision. It's a trust decision. The whole system is built on the assumption that the baseline asset is stable, liquid, unquestioned. When that assumption wobbles, the tremor runs through everything: credit, collateral, funding markets, risk parity, portfolios that were designed for a world where safe actually meant safe. And in that moment, gold and silver stop being commodities in the old sense. They become what the script calls counterparty risk hedges, insurance against institutional dysfunction. Not because metal is magical, but because it sits outside the promise stack. No issuer, No rollover risk, no committee vote required to exist. Then the narrator introduces the real enforcers, the so-called bond vigilantes. Investors sell bonds, yields rise, and suddenly the government and the Fed face the choice nobody wants to say out loud. Cut spending and tighten into a politically fragile economy, or print and cap yields. Effectively admitting that the currency will take the hit. The script describes the Fed as trapped. Raise rates and you crush government finance, monetize and you reignite inflation. That trap is the bridge from a normal commodity bull market into something more dangerous, a monetary bull market, where silver trades less like an industrial input and more like a lifeboat. In that regime, the price doesn't move because of a new solar panel forecast. It moves because the public begins to sense that purchasing power is being managed, not protected. And that's the final twist this chapter delivers. Inflation doesn't leave. It returns in waves. The script frames it as a slow transfer, financial repression, where savers get quietly taxed and debtors get quietly rescued. In that environment, silver isn't just going up. It's repricing the credibility of the system. The physical tightness was the first clue. Macro is the motive. If the macro chapter gives you the motive, trust cracking, bonds wobbling, currency pressure building, then the next step is ruthless. How do you confirm it without falling in love with the story? Because narratives are cheap, charts are expensive, the script makes that pivot on purpose. After why, it moves to how. And it does it with a clean decision tree, targets not as predictions, but as checkpoints. In other words, if the system is really under stress, it will leave fingerprints, and you can audit those fingerprints in real time. The first anchor is $71.47. Not because it's magical, but because it's where the market already told you something important. That's the zone where the sell-off found a floor, where bids showed up hard enough to stop the bleeding. In this framework, $71.47 is the baseline, your truth line. If price loses it cleanly, the script implies you treat the entire thesis with skepticism, because real forced flow doesn't usually let obvious support break without a fight. But if price holds that zone and starts climbing back, the next level becomes the first real test of institutional intent. Checkpoint 1 is $75, the prior high, the obvious breakout point, the number everybody saw before the drop. The narrator ties this to timing. If pensions, endowments, and large allocators are truly stepping in as January machinery turns on, $75 should be reclaimed fast, roughly within the first 48 hours of reopened trading. But the level is not the point. The quality is the point. A break above $75 on heavy volume, with clean follow-through, is framed as confirmation that the correction phase is over and forced buying is now driving price discovery. A break above $75 on thin volume, sloppy, hesitant, easy to fade, is framed as suspect. It could be a head fake. It could be the market baiting late buyers before one more shakeout. Same number, different meaning. That's why the script keeps repeating the same doctrine. Don't worship the price. Interrogate the structure. Checkpoint 2 is $83. The prior wick high, the crime scene. The narrator uses that phrase deliberately because wick highs are where markets leave scars. That's the place price teleported up, then collapsed, leaving behind evidence of stress, liquidity gaps, and possibly engineered volatility. In the script's logic, markets revisit crime scenes the way detectives revisit a location, to see what's changed. Are the same sellers still there? Is supply still waiting at that level? If price returns to $83 and the sellers are gone, or if they get absorbed quickly, then the implication is violent. The ceiling wasn't real. It was temporary, and when a ceiling disappears, the market doesn't crawl, it surges. Checkpoint 3 is $100 plus. Framed as a psychological